Understanding credit creation and the role it plays in the economy. What is credit? Credit is a form of money and is created when banks give out loans. It is not about printing physical paper, but is an expansion of bank electronic deposits. So credit creation is a process by which banks generate this new money through lending to businesses or individuals. How does it work in practice? When a bank gives out a loan, whether it's for a home, a car, or for a business to grow, it doesn't move that money from someone else's savings. Instead, it creates new money out of thin air. The new loan appears as an asset on the bank's balance sheet, while the funds it lent out appear as a new bank liability in the form of a customer deposit. This lengthens the bank's balance sheet and increases the money supply. And to learn more about this, check out our earlier video, How Do Banks Create Money? Bank credit can be categorized as either being non-GDP credit or GDP credit. Non-GDP credit means a credit created is for a transaction that does not contribute to gross domestic product, such as a loan to purchase a new house. This credit is called financial credit creation. Whereas GDP credit directly contributes to the growth of nominal GDP. This category can be split further into two types of credit: consumption credit and investment credit. As you can see, we now have three types of credit that can be created. Each type affects the economy differently, so it's important for us to be aware of how much credit is being extended and what it's being used for. Credit creation impacts your everyday life. Let's delve deeper into the three types, starting with case 1, financial credit. Financial credit involves credit that's being used for financial transactions that do not contribute towards GDP, such as banks lending for the purchase of corporate bonds, financial speculation, or lending large amounts for real estate purchases. This ultimately boosts the underlying asset prices, resulting in significant asset price inflation and large unsustainable bubbles. This type of credit creation inevitably results in an economic crisis with sharp market corrections, increased bankruptcies, and increased unemployment. A very clear example of this is the infamous Japanese asset price bubble of the 1980s-1990s. A record number of cheap credit was created for both corporations and consumers to purchase real estate and land, pushing up prices to unsustainably high levels. At one point, the lands of the Imperial Palace in Tokyo was worth more than the entire state of California. With these highly inflated prices, Japanese corporations began using their real estate as collateral to, literally, buy up the world. Of course, this highly inflationary monetary policy was always doomed to fail, and as soon as bank lending began easing up, the markets collapsed and an economic crisis followed. Is this just history? Although not as severe, the following is a house price index for Germany over the last 20 years. As you've just seen how financial credit creation is unproductive, so is consumer credit creation. Consumer credit refers to loans extended for personal spending. This type of credit creation does not result in any new goods or supplies, but rather allows people to purchase a greater amount of existing goods, which inevitably results in consumer price inflation, which is amplified when there is an existing mismatch between demand and supply. Using the UK as an example, between 2021 and 2023, through furlough and direct bank lending to consumers, resulted in people being able to purchase more without an increase in the number of goods and supplies. Amplifying this with supply chain disruptions led to significant consumer price inflation. Yes, nominal GDP grew, but the growth was not real. Investment credit is an example of productive credit creation. Investment credit is used for productive business investments like expanding facilities, improving technology, or developing new products. This type of credit creation supports real economic growth without high inflation. Productive use of credit increases efficiency, sparks innovation, and generally contributes to sustainable economic growth, better living standards, and economic prosperity. To summarise, financial credit primarily leads to asset price inflation, which can result in sustainable bubbles and damaging banking crises. Consumer credit increases consumer price inflation, often resulting in nominal GDP growth with little or no real growth. Investment credit drives the economy and boosts nominal GDP growth without inflation, resulting in real economic growth for countries. While credit creation is a powerful economic tool, how it's used impacts your everyday life. With great power comes great responsibility. Thanks for watching. If you enjoyed this explanation, please like, subscribe and share with friends interested in making sense of economic principles.